We'll make a start there. So good afternoon, everyone, and welcome to the webinar this afternoon, the Ensors webinar. As the title slide says, there are 7 key things to know when buying or selling a business in 2021. We've picked the 7 key issues which we think are most relevant to buyers, sellers, funders, and advisors. If you are contemplating or advising on a transaction during 2021, we've tried to make them as specific as possible, knowing that we're mid or post-pandemic, whichever you want to look at it, the impact that that's had on companies, the impact that that's having on transactions. So these are specific reasons and specific issues that you need to look out for during this current year. You know, never before has there been such a dramatic impact on company financials in particular. And between Simon and I, we'll go over some of the things that you need to look out for during the coming year. So we're split into 2 sessions. So I'm shortly going to hand over to my colleague Simon. Simon's the director in the corporate finance team. He's going to give a brief overview of the market, so you get a feel for where transaction levels are at the moment, because that's quite important. He'll then cover issues 1, 2, 3. And then I'll take over and cover issues 4 to 7. Hopefully at the end, we'll have some time for questions. We very much hope so. And as is standard for these webinars, if you can use either the chat function or the Q&A function to jot your questions down as we go, then we can pick them up at the end. If you feel brave enough, then you can unmute at the end if there's some questions you want to leave at the end, and we can do it that way. So without further ado, I will hand over to Simon.
Great. Cheers, David. Hi, everyone. Thanks for joining us. As David said, the focus of this webinar is to look at the 7 key issues which buyers and sellers should be aware of when structuring transactions in 2021. So we'll look at each of those separately, but first I thought it would be useful just to have a quick look at the current marketplace and how things have been progressing over the last year. So this is information from Mark to Market, and actually it is good news, and we haven't been able to say that much over the last year. But this chart shows the amount of monthly deals that they track as completing by a month, and as we can see, it starts in about May 19. The orange line shows the average of May 19 to March 20, so just before the real pandemic effect happened, and it bounces along at just, I think it's about 318 deals a month on average. So then it drops off in April and May, but then June shows signs of recovery. And what happened after that is pretty amazing, really, because it's just shot like a rocket. And as at March 21, we had over 600 deals. So if you look at that just in the context of the May, June or July 19 numbers, it looks absolutely huge, and probably couldn't have expected that 18 months ago. When I first looked at this, I thought, oh, maybe it's just a bit of pent-up demand there, and it's just leveling out from the lost deals in April and May, and to a lesser extent June. But the 12 months between May 19 and April 20, there were just under 3,700 deals in total. So although April 20 is a little bit affected, 3,700. In the 11 months since, there's been just under 4,100. So year on year, up by 400, 10%, with a month to go still. So even if it bounces back down to say 300-400, we're probably going to be up 20% looking year on year. So there's been plenty of deals about, and the question we always get asked really is about the multiple. That's what most people want to know. But there's probably more to think about rather than just the multiple. That is one key point. But you really need to look at the wider structure, because if I'm a seller and I say, right, I want £10 million, that's the number where I'm quite happy to walk away. If I get a set of heads of terms and it says 10 million at the top, so job done on that side, the number's there. But then I only get paid 2 million up front and 8 million's deferred over 5 years. Is that really what I was aiming for when I said 10 million? So all of these other points come into play, and you have to look at them all together, because there's definitely been some more creative structuring done over the last year. These are the 7 issues that we're going to look at. I'm going to start with earnings and then look at deferred consideration, building onto that to contingent consideration. And then from there, David will take over and talk about lockbox or completion accounts, so the actual mechanism as at completion, a bit on funding, tax, and then finishing up with the most popular one, the multiple. So earnings, it's our first key issue, and by that I mean, which figure do we use for constructing our offer? When we're calculating our enterprise value, so cash-free, debt-free value, we take our earnings and we multiply that by the number of years that as a buyer, we're happy to wait to receive back our investment. So putting some numbers to that, say we had earnings of 2 million, the business should achieve 2 million going forwards. We want our investment back in 5 years. So the enterprise value becomes 10 million. But if we get the wrong earnings number going forwards, so say we miss by a long way and earnings is actually 1 million going forwards, we've paid enterprise of 10 million, our effective multiple is 10. So we can quote what we like at the time saying we paid a 5 multiple, but we've actually going to have to wait 10 years to get our investment back. So clearly the economy is very choppy, volatile, and that's the same for business earnings. So we're looking at what profit number we should use for either assessing an offer made for our business or making an offer for a target. Which number should we use? We could use some kind of weighted number, so put in 3 on the most recent figure, 2 on the year before, and 1 on the year before that. I suppose the disadvantage is that you then put in most weighting on a pandemic affected period. We could look at last 12 months, which was probably the most popular before the last year. So that would be just looking at the last 12 months, but clearly that's going to be pandemic affected as well. We could take EBITDA a step further. So EBITDA is the usual or the most popular metric to use for assessing earnings. So it's earnings before interest, tax, depreciation, and amortization. So we could take that a step further and normalize for COVID impacts. And probably the easiest way of doing that and quantifying that would be to completely ignore the year where the COVID impacts happened. Putting some numbers to that, if we had an EBITDA in our COVID year of 300,000, we're forecasting 1.6 million next year. Last year or the year before COVID, we made 1.6 million, and going back a couple of years, made 1.4 million. So it's good business. It's got a track record. It's not that it's just pulled a forecast out of the air. So using weighted earnings on that, we'd have about 900,000. We could use a simple average of across all 4 to get to about 1.2 million. We could look at the last 12 months, which at its lowest would be 300,000, but could be ebbing up if you're eating into the forecast period. Or we could completely ignore that COVID year and go for EBITDA of 1.6 million. Not all companies you look at would be straightforward to this, but there'd probably be quite a lot of justification for looking at EBITDA on this basis. And which one would be used would be an item for negotiation, depending where the balance of power lies. Obviously, if you're a seller and you've left it a bit late to retire and you need to get it out, then your leverage is probably lower than somebody who could quite happily wait around 5 years, take the money until the next deal comes around. I do think EBITDA is going to get more popular over the next year. There are a few deals that used it last year, or they said they used it, but really you don't know whether in actual fact they were offering a lower multiple than they would have done otherwise, and they just dressed it up as, yeah, we're ignoring the pandemic year. I think as a seller, to be able to justify this, it becomes vitally important that you've got good quality and management information. So if we're saying next year is going to be 1.6 million, we need to have monthly figures, monthly budget, and probably to more detail, order book, pipeline, things like that, where we can then measure the actuals against them to show that actually we are tracking at that kind of level. And that's where a fair offer should be placed. Because otherwise you can't really expect someone on the back of 300,000 to accept that 1.6 is normal. So you have to do your best to lessen the risk for them. I think as a buyer, management information is also really, really important. I know some businesses, more if they're coming to retirement sales, sometimes aren't as modern with their practices maybe, and it's just something that you have to wait till the end of the year to get numbers, or you get numbers maybe on a monthly basis that haven't got depreciation adjusted or any year-end adjustments. But as a buyer, even on this example, say we did a deal using the weighted 900, so we might think we've won in some ways because forecast 1.6 million. But if they're actually tracking at 300,000 going forwards, then we've overpaid by 3 times. So we might think that we're paying a 5 multiple, where in fact we've ended up paying something huge like a 15 multiple. So I think the quality of information becomes a lot more important when there's a volatile trading background. Our next key issue is deferred consideration. So this is where you agree a deal price, you get paid an amount up front, but then there's some consideration that's deferred over a set period, maybe for a couple of years. If someone came to us, say 18 months ago, a year ago, and said, we've got a deal, we're getting 80% up front, 20% deferred, it wouldn't sound, it would sound quite usual really. Each business is different, so depending on the asset base and the other components of the deal, it would change, but 20% would have sounded about fair, in the right ballpark. Over the last year, what we've seen increasingly is that this part of the pie has grown. So now it doesn't sound, or it wouldn't be out of keeping with what we're seeing if someone had an offer where 40% of it was being deferred. It just seems to have grown a lot more in the last period. If you think about what is a fair level for deferred consideration, I think you really need to look at the asset base, because if you've got say a business that's got £4 million worth of assets, the deal value is not much over that. So say 5 million, if someone's coming to you and they're saying they only want to pay 2 million up front, you'd probably look at that quite skeptically, especially as a seller. The day before completion in that example, you've got the power to control £4 million worth of net assets. The day after completion, you might have £2 million in your pocket and a bit of paper to say that you owed 3 million. So actually just skipping back to the split of deferred consideration, I think previously or why deferred consideration is used a lot of the time, there used to be 2 main reasons. One of those would be funding. So maybe the buyer can't afford to fund the whole amount up front, so it's might be a good price, so you're happy that they fund the ongoing amount out of profits or other cash flow. It could also be a function of their risk perception. So if they think that this deal is maybe a bit more risky, some skeletons in the closet, and there might be some legal claims down the line, they may prefer to defer some of the consideration. They still need to prove that it's a correct claim if there was a legal claim, but it's a lot easier to get the money back when it's in their pocket rather than if it's gone all to a seller on day one and the money's already been spent. I wouldn't say that either of these singly are the reason that this is increased. I think it's more likely just to be buyers have been quite opportunistic. So they know that people have got a price they want to get out. They also know that probably their risk profiles changed a little bit, and a lot of sellers are thinking that things change so quickly, maybe this is the time to get out now. So by deferring more, we can make it a more favourable deal for us as buyers while still ticking the boxes for the sellers. And moving on from that a bit further, that from a seller's perspective, if a larger slice of your pie is being deferred, probably need to think more seriously about security. So previously, if we had, say, 5-10% being deferred, security may not have been worth the trouble, or you may have paid lip service to it. Now, if you're having this kind of size deferred, you want some decent security to make sure that you're going to get your money, even if it is a funded buyer. At least having some security there could act as a deterrent. And from that, you need to think carefully about where you take the security. For example, if you take it over the target, you need to be careful that it's not possible to maybe take all of the assets out of the target and just leave you with a charge over an empty shell. The next step on from deferred consideration, contingent consideration, which is our third option, and that differs to, or our third key issue, and that differs to deferred consideration because it's an element of the price which is only received if targets are achieved. So whereas our deferred, it's a bit like a loan really, you get paid, say, 2 million over 2 years on X dates, and it's fixed, whereas this is you only receive your money if you hit the targets. And this could be an important tool in bridging the gap for the performance in the COVID year. If we think back to our example before, where maybe the seller thinks we're going to do 1.6 million going forwards, but it's currently tracking at, say, 300,000, 500,000. Really, it's for the seller to put their money where their mouth is a bit and back their company that this money or this profit is going to be achieved going forwards. And due to that, we're quite happy deferring some more of the consideration, or making some more of the consideration contingent until we achieve those targets. Flipping it around, as a seller, you need to be very careful what you sign up for and what can be done to protect the ongoing trade of the business. If you're not going to be involved in the business, you've got no say over what's happening. You have to be very careful. For example, say you have a buyer and the day after completion, they sack all of your management, bring in their own management team, run the business absolutely poorly. Everything goes downhill, and then you don't hit the profit targets. Is it really fair then that you don't receive the funds that you're expecting to, just because of how it's been run afterwards? So there's a lot to think about. One other point is to watch out for is just whether there's any reverse ratchets in the agreement. So these are more common in revenue deals rather than profit-based targets, but it could still be possible, and it could be that it's accidental through the legal drafting or just not as expected. But this would be the kind of thing, say you've got a 10 million deal, you get 8 million up front and you get a couple of million based on targets. If, like in our last example where things go really badly, say the formula actually works out that the consideration should have been even lower than 8 million to start with, do you have to give any of that money back, or is it saved and banked as soon as you receive it? Just to wrap up with a contingent consideration, I thought it'd be useful for an example of how earnouts can sometimes act not as expected, and probably no one in the transaction would have expected it to, but it's just how it's worded. So this is a one-way earnout, so there's no reverse ratchet. And effectively, if we hit 2 million EBITDA in years 1 and 2, we get an extra £500,000 payment in both of those. If we miss those targets, the payment's reduced on a pound for pound basis. So for example, if we get 1.9 million EBITDA, we've missed it by 100,000. So our payment is actually 400,000. So what could happen in year 1? We've actually got 1.5 million EBITDA. So our payment's reduced by £500,000, which is fair enough. We haven't hit the target, so it would be as expected. But then in year 2, if we make 2.5 million, we trigger the £500,000 payment. So that's good news. We get that. But if you look at it overall, our target was to achieve 4 million EBITDA over 2 years, which we've done. And then on the target, we'd get paid £1 million. But because of how the profit has fallen, we've actually only achieved £500,000. And this is just an example of the games that could be played with earnouts. because you could have some kind of creative accounting, maybe, where they've pushed back some of the sales from year 1 into year 2. There's just a lot of different things that could happen. So really, when you are using an earnout as a seller, you need to be very careful about how it's policed, because something like this could just happen accidentally. It may not have even been by design. And at that point, I will hand over to David.
Thanks, Simon. Hopefully I'll get control of the screen and I'll be able to go back one. Typically be able to go back. Anyway, so thanks for that, Simon. Great first 3 issues. So moving on to key issue number 4, lockbox or completion accounts. It's a question that we're often asked, and some of you on the call will know exactly what these are, and others it may not mean very much. So firstly, I'll explain in brief what they both are. So completion accounts, as the name would suggest, are drawn up at completion, albeit it's a retrospective process. So they're drawn up as at the date of completion, and typically it will take somewhere around 30 business days is allowed for one party to draw them up, and then there's typically a review period. But the key point is it's after the event, so nobody truly knows what's going to happen with completion accounts until they happen, and they actually turn up on somebody's desk. And there's always that slight sense of trepidation that are they going to deliver what the buyer and the seller expects. A lockbox, on the other hand, sets the price based on a pre-completion balance sheet. So you're taking that uncertainty out of the equation. And this is why we think they will continue to gain popularity this year. So they've been popular for a while, particularly with financial private equity buyers and sellers like them because of the predictability. But we think that popularity will continue and increase this year because of some of the issues that Simon has mentioned. Now, what completion accounts and lockbox do is they deal with the balance sheet adjustments. So Simon's talked about earnings. Later on, I'm going to talk about the multiple. What those 2 things do is derive the enterprise value of a company on what we call a cash-free, debt-free basis. You have to appreciate that you could, in theory, have 2 identical companies that produce the same amount of profit, but one might have £2 million in the bank and own a property, and the other one might have £2 million of a debt and lease its property. At what we call an equity level, those 2 businesses are going to be worth very different things. Therefore, there's a mechanism required to deal with that, and that's what these processes do. So, as I said, lockbox adds certainty, which is why we think it will continue to gain popularity this year. But there is a couple of things to look out for. So for sellers, you have to, because we're going to lock the box early before completion, if you've got a very profitable company, the gap between the date that we strike or we close that lockbox, if you like, and completion, there's a notion that you could be losing profitability in that period. Again, that's subject to negotiation. There are some mechanisms to deal with that, but essentially that's what's happening. And a buyer really needs to have conducted some really good, strong financial due diligence, because ultimately they are going to be relying on a pre-completion balance sheet, which is usually a set of management accounts. So they've got to have really 100% confidence that those accounts are good and accurate. So just as an example, considering a deal with a £12 million headline price or enterprise value. So here we've got a price adjustment on a pound for pound basis, and we've set a net asset target of 2 million. Sometimes it's more complicated than that. I don't think there's any such thing as a common deal. Sometimes it's current assets rather than net assets, but to keep this example simple, we've just used net assets. The offer date or lockbox date, 31st of March. So if we picked that and we locked the box, or we completed on that date, there were £2 million worth of net assets, and the total consideration was 12 million. If we did completion accounts and we take the next example along to the right, and profitability, the company had been profitable, it had increased its balance sheet by £1 million in that period, we'd actually get an uplift in total consideration to 13 million. Whereas in a lockbox scenario, you wouldn't as a seller. So that's something to look out for. Again, it can be negotiated in what the actual lockbox. You can make, there can be a halfway house, but in its literal form, this is how it works. But it's worth just looking at the column in red, because this is where the risk is really for, arguably for both sides. If there is a loss in the intervening period between the lockbox date and completion, then potentially there could be a reduction in their assets, which in a completion accounts process would come out in the wash. The seller would receive less money, and the buyer would pay less money. But in a lockbox scenario, unless you'd seen this happening from the management accounts pre-completion, potentially you're going to be overpaying for the business. So that's key issue number 4. Key issue number 5 is funding. And I know we've got a number of funders on the call today, so I'm always a bit wary about presenting this. And I'm sure if you've got any questions or observations, you can make them and we can pick them up at the end. But actually, it's pretty positive at the moment. I'd be interested to see whether people agree with this. But the first thing we've looked at here is a survey of M&A mergers and acquisition professionals. And actually, the sentiment at the moment is that UK professionals are actually pretty confident. So there's a couple of graphs there, both in a different shade of green, but the one to the left-hand side is basically professionals' levels of confidence versus a pre-COVID period. So what you'll see there is that 80% of UK professionals at the moment predict the availability of debt finance for transactions is stable. And only just under 20% think it's decreased, which I think, given what we've been through economically over the last 12 months and beyond, is a pretty good confidence position. It's interesting, I haven't got the figures there, it's interesting that over in Europe it's not quite so confident. I'm not quite sure what's driving that, but the question really here is, will it get tougher in the UK during 2021? You know, things that we've talked about on other webinars, such as, you know, when stimulus, things like furlough and civil money starts needing to be repaid, at what point does it get more difficult, if at all? That's a bit of an open question, really. So what are the issues to look out for in terms of funding this year? So those volatile historical results, which Simon mentioned, they're just as important for funding as they are for valuation. So if you think, obviously, profitability ultimately turns into cash flow, and it's cash flow that's important if we've got to repay debt. So we're really concerned with how robust those earnings are. We think, and we've already seen in a number of transactions, that makes cash flow or term loans harder to substantiate, and therefore harder to come by in M&A transactions. That's what we think will probably be a continued trend in this year. It's not to say they're not available, it's just more difficult to get them because it's really hard to establish what level of profit and therefore what level of cash a company can make. We've also seen issues on positive COVID impact as well. You have to remember that some companies have actually benefited in an economic sense from COVID, either temporarily or permanently, because they happen to operate in industries where COVID has had it's been a positive for their industry. We'll look at that later on when we look at multiples. But again, that to an extent that needs to be normalized if it's not a permanent increase going forwards. So we think there'll be a continued desire to look at secured lending first and foremost during 2021. So the ever popular invoice financing and the other streams of asset-based lending are and will continue to be popular. Also on funding, be interested to see where we go with government-backed debt. So we talked about CBIL already, but we have seen examples during the last 12 months where CBIL has been used to acquire businesses. We've even seen people promoting CBIL as a way to buy businesses. And sometimes it's been used when it wasn't the original intention of the debt in the first place, but it can be justified on the basis of growth and expansion. Still early days to see how the recovery loan scheme will fit into that picture. Now, clearly, you don't get the benefit of the interest-free period that you would have done under the CBIL scheme, but nonetheless, it's still a relatively sort of soft form of finance compared to traditional corporate finance lending. So it'll be interesting to see where that goes over the next 12 months. Also, what impacts raising debt is the level of existing debt in a company. And there's some kind of debt that you wouldn't necessarily recognize in normal circumstances. So for example, we've still got HMRC deferrals kicking around. VAT was deferred by most companies last March, and you don't have to pay that back yet. It's starting to creep out. If you've agreed to pay it over the next 10 months, it's still there. So beware of that when you're looking at cash flows this year. And also lurking other creditors. So there could be landlord is a prime example. We're being told, certainly our contacts in HMRC and landlords as well, is that there is some pent-up demand there to take action against defaulting companies that have chosen not to pay their liabilities, even if they could do. And therefore, they've been restricted in using winding up orders over the past 12 months. So potentially we might see that as a factor this year. And then finally on funding is that ultimately, if there is a squeeze on funding, we're not seeing it just yet, but if there is a squeeze on funding, that's likely to have an impact on the price that companies are able to pay. But also probably in the short term, another issue or another reason why there might be more deferred consideration. So Simon talked about that earlier on and said, if there's less funding, the price might stay the same, but it may mean you just have to wait longer for your money if you're a seller. So some of these issues obviously cross across each other as we go. Number 6. So we got into 6 out of 7 before we've talked about tax at all, which is quite good. But actually the tax landscape at the moment is quite benign. It's quite stable until at least the autumn, when there's due to be another budget. It's usually quite late autumn, almost into the winter. It was moved this year to early March because frankly, nobody knew what they were doing in the autumn. So they decided to move it further down the line. Now, I doubt many people on the call will have escaped the rumours that were in some pretty good press about the fact that CGT was rumoured to go up. At the moment, if you sell a business asset, largely you're going to pay 10% on the first million as a shareholder and 20% thereafter. So what was in the financial press at the beginning of 2021, at the end of 2020, was actually something coming out of the Office of Tax Simplification, which said that their recommendation was to align capital gains tax with income tax rates. So you're looking there at worst, even more than a quadruple effect on effective tax rates from 10 to 45%. And there was also some fears that business asset disposal relief, or what it was formerly called entrepreneurs relief, was going to disappear as well. Well, business asset disposal relief was retained and there was no changes to rates, which was quite interesting. This definitely fueled a number of transactions. The rumours were really strong at the beginning of 2021, and a lot of transactions were arguably forced over the line pre-budget because people were so nervous about it. I think the mood music from HMRC, or from the Treasury really actually, was dampened down a bit towards the budget, and it didn't feel like there was going to be a significant increase. And it was mainly the news coming out of the Office of Tax Simplification. But having said that, it's not a bad tactic for the Treasury to have these rumours pre-budget because it drives activity. And I think I've been doing this a long time, and every budget or every pre-budget, there's a rumour that this, entrepreneurs relief is disappearing or CGT is going up. And the cynic in me suggests, along with some of my colleagues, that might be a tactic to raise tax. So what we have seen post-budget, though, because there were no changes and no anticipated changes going forwards at the moment, we've seen sellers, owners of businesses, come to us to conduct a controlled sale process. So not try and do something really quickly pre-budget, but actually do it in a controlled way. Because as a seller, I think there's one certainty: CGT rates are likely to be as good as it gets. I think if there is going to be a change in CGT, it's unlikely that rates are going to go down. They're likely to go up at some point in the future. And right now is a good time to sell if you want to bank that taxation advantage. As we get closer to a budget event, whether it's this year or next year, potentially those rumours start again. Potentially you get slightly more concerned as a seller, and you might be willing to accept less money, or the buyer could take advantage of that position because there's such a significant potential amount of net proceeds at stake. So that's what we're seeing in terms of general taxation at the moment. I wanted to brief another point, however, on timing of completion. Now, this isn't anything new, but it's something that is more relevant if we see transactions with a greater proportion of deferred consideration in them. So if I look at an example, so we've got a transaction, if we fast forward until March 2022, this is a deal that's got 50% upfront and 50% in 2 tranches over 2 years, so 25% after year 1 and 25% after year 2. Not an untypical transaction, I would suggest, in the last 12 months. So if we completed that deal on the 31st of March 2022, the tax, you have to make an assessment of your taxation on the overall transaction prior to the submission of your tax return. That's due on the 31st of January 2023 on the entire sum that you expect to receive. So let's assume you expect to receive 100%. You've got to pay all of that tax on the 31st of January 2023, and you've got to wait a long time, or certainly another year, before you get all of your consideration. So that's one example. If you move the completion date by just 6 days, and this happens at every tax year, it's not just in 2022. But in our example, if we moved it to 6th of April 2022, you're going to get another instalment on 6th of April 2023. So you've only, again, moved that forward by 6 days. I think we can live with that. You've then got 75% of your consideration in the bank. On the 31st of January 2024, so a full year later, you've only moved the transaction by 6 days, but a full year later, your tax becomes due. At which point, you know you've got 75%, and you've only got a couple of months to wait before you get 100%, hopefully. So when you put that return in, not only have you got a cash flow advantage of the fact that you've got 75% of your money, you've also got the fact that if you've got to make an estimate of what you think you're still to return, you've got a much smaller period to make that assessment. So significant cash flow impact and benefit for sellers that shouldn't be missed, really, when we're talking about transactions during the next 12 months. So finally then, key issue number 7, multiples under pressure, ? We're delivering quite a lot of good news in this webinar, actually, in terms of transactions. And if you get a high volume of transactions, then unless there's a great proportion of distressed deals out there, you're going to see multiples holding up. And that's what we've seen so far. So this compares the 2 halves of last year. There's always a lag on data like this. But the first half of last year, if you remember, it seems like an awful long time ago. Certainly the first quarter would have been not affected by COVID. So actually, there's very few sectors that have seen a dramatic decrease, or actually none of the sectors have seen a dramatic decrease in the multiples. But there are some that have performed better than the others. And the reasons for that is because they are popular sectors at the moment, and those won't surprise you. So those in IT services, anything with predictable or recurring revenue streams are really popular at the moment. Healthcare and pharmaceuticals, for obvious reason. E-commerce and web shops, again, for obvious reasons. Those are popular businesses. So they've actually seen an increase in the level of multiple that buyers are prepared to pay, those numbers of years to reach your investment that Simon talked about earlier. There's been some industries that have struggled. Again, they won't surprise you. Hospitality is down there and retail is down there as well. They've both had corrections, but probably not as much as you would think. And that's perhaps because distressed transactions haven't really got going in those sectors. Those businesses have been mothballed, and time will tell what happens to those going forwards. So what that derives is an average EBITDA multiple, an average profit multiple of 5.4 in that period during 2020, which actually feels about normal to us. And as the data there suggests, we're not seeing a dramatic decrease at the moment. We often, when asked to quote a multiple, it's a dangerous thing to do, particularly when we're professionally valuing businesses, but often spoken that a multiple of 4 to 6 is fairly normal. So we're within that range and perhaps towards the upper end of it at the moment. But will multiples fall, or when will multiples fall, if they do at all? It's worth thinking about the previous recession, actually. I mean, this is a really different recession. The contraction was massive, like off the scale in terms of GDP. But last time there was a lack of liquidity, a lack of money. What we saw last time in what we called a credit crunch recession was a delay because there were part-baked deals. Deals were already in the offing, and then if they didn't get pulled, they got completed largely at the same multiple that they would have done pre-recession. You see that to an extent in this time period as well. So there's always a bit of a delay in the data as deals start to come through the pipeline. This time around, however, because there's a far greater volume of deals going on. I mean, I remember back in 2008, and my team get bored of me saying it, but I remember the phone didn't ring very much in 2008 because there weren't really very many deals going on. And if they did, they had an element of distress. We're not in that environment at the moment. Who knows what's going to happen going forwards, but certainly 2021 doesn't look like it's going to be that kind of year. So currently, we're seeing just a minor fall in some sectors and largely the sectors that you would expect. Most industries are proven pretty resilient at the moment. So as things stand, no indication that multiples are about to plummet, which is great news for sellers. Equally unlikely to go through the roof either. So from a buyer perspective, I don't think we're going to be in a situation where, like the housing market has had a huge amount of stimulus. I don't think we're in that kind of area in terms of multiples. So I think it will be a pretty steady year for multiples paid for businesses. But beware the quoted multiple, as Simon mentioned earlier, depending on what you do with earnings, 5 times multiple could be easily be quoted as a 10 times multiple, and so on. So certainly I think probably multiples aren't under pressure at the moment, but watch this space. So to conclude on those 7 issues, a bit of a whistle-stop tour through them. Earnings, deferred consideration, contingent consideration, lockbox or completion accounts, funding, tax, and multiple. These issues are relevant to all buyers and sellers. While some are more relevant to sellers, so the tax is evidently more relevant to sellers, as a buyer, you need to be appreciative of those factors. So you can either use them to your advantage or you can be sympathetic towards them. So those issues are relevant to both sides. Personally, I think the biggest one is where we started, which was with Simon, the earnings. That's going to be the biggest challenge. I've said also it has a knock-on effect to the raising of debt finance as well, or equity finance, which we haven't touched on today. So the data is suggesting, and these factors are suggesting, that actually 2021 looks like being a busy year. It will be interesting. It will be challenging. Never before have we seen volatility on earnings that we've seen in the last 12 months, and that will bring some challenges, as we've explained. So at that point, just wanted to open it up to the floor and see if there are any questions. I think I'm right in that if anybody is brave enough and they want to unmute themselves, they're welcome to ask a question verbally. No, it's not uncommon. Okay, that's fine. Is there anything you wanted to add, Simon, or are you?
No. I think it's just the general point, isn't it, that there's so many moving parts of a transaction. You have to think about all of them together. And then when things are a bit more creative, it just requires more thoughts just to make sure you don't get tripped up when things aren't as simple in the structure. Yeah,
I'd agree with that completely. So it's good that we're not having to deliver lots of bad news about 2021 and beyond. We think it will be a positive year for transactions. We hope that those of you that are listening and have taken part today. Oh, I've got a question. Just as I was wrapping up, thanks, Andy. Is there a change in the blend between MBO and external buyers? That's a really interesting question. So what we've seen, and I can only talk from our own firm's point of view, we have seen more sellers come to us wanting to sell to trade, certainly post-budget. We've got more sale mandates on our books than we've probably ever had at the moment. I can't really say whether that is replicated across the board because clearly, not everybody is going to disclose what they're up to at the moment. MBOs are still really popular, and they're a really good way of selling your business because you've got an element of control. We've done separate webinars on that before, but particularly in a slightly volatile market, and particularly if owners are prepared to accept a reasonable deferred period, it can be a really smart transaction to do. Good for both sides, great opportunity for MBO teams. So at the moment, we're seeing a bit of a shift towards sellers wishing to look at trade, but MBO is still strong. Thanks, Andy. I hope that answered the question.
That's a good thing about webinars, isn't it? You can't get a follow-up.
Yeah. Okay. Well, at that point, because we've literally just run to time, we're just a minute over, and I'm sure everybody's got plans now. So I'll wrap up there. Christy will be in touch to receive any feedback after the event. So I'd just like to wrap up and thank you all very much for attending. It means a lot. So look out for future webinars and speak to you soon. Cheers. Bye.
Thanks all.